Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This is part 5 of a 5-part series where I covered the 30 Dow Jones Industrial stock constituents. This particular group is the most reasonably valued based on PE ratios of all of the 30 stocks. The 5 stocks I will be looking at in this video are Cisco, Goldman Sachs, IBM, Intel, and Verizon. I would also have covered the Dow stock, but the problem is they just recently merged. Dow and DuPont recently merged, and there's no history, so I will not be showing this stock in today's presentation. As I usually have, what I'd like to start out with is kind of building a fast graph for those who aren't familiar with the tool. So the first thing I have here is I have a plotting of Cisco's adjusted operating earnings going back to fiscal year 1997, which ended in July, through current with some estimate data included. And what you see here is a company that's had a pretty good operating history historically. They've had some down earnings in the recession of 2000. They also had a down year in the Great Recession of 2008. But otherwise, you can see that the company's been a consistent grower, averaging about 12.5% over this long period of time. However, if I cut the time frame down to only 15 years, you see that growth rate has fallen to only 7.6%, and I drop it down to 10 years. It's fallen to 5.6. So what I'm looking at here is the operating history of Cisco. The next thing I'm going to bring into the graph are dividends and the dividend payout ratio. That's the white line on the graph. You can see that Cisco paid their first dividend in July of 2011, and they've grown that dividend very nicely, and they've increased their payout ratio along the way. You can see they're paying out about half of their earnings in dividends. Down here you can see the payout ratio went from 7% and progressively increased to where last year, which was this fiscal year of 2017, they paid out 46%. Now the triangles on the graph are listed as fiscal year data. The graphs are drawn in calendar years, but the data is produced in fiscal years. And then the next thing I want to bring is that we take these dividends here while they still belong to the company and pay them out to the shareholder. So the shareholder is getting dividends expressed two ways. This is the growth of the dividend and the payout ratio, and this is the dividends after they've been paid out to the shareholder. The next thing I'm going to bring on the graph is the monthly closing stock prices. And this is a very interesting graph because generally speaking, a stock price will go where the company's earnings go. But there can be times when stock prices get totally disconnected. Of course, there's no better example than that than tech stocks going back to 1997 through calendar year 2000, where you had this irrational exuberant period. You can see the PE ratios on Cisco got up to 160 times earnings. The company was continuing to do well, but then as we came into the recession, we got some bad news. You saw Cisco's stock price fall from a high of 77 on March of 2000 all the way down to a price of $10 by September 2002. This was strictly a function of overvaluation. We also see the result of several years of poor performance because the valuation, even after it corrected, remained excessively high. Of course, this was a period of time when Cisco was growing faster. And then more recently, after we came into the Great Recession, the valuation has been lower. Now we calculate what's called a normal PE ratio. And mathematically, this is the correct number. This has been a 26 multiple over this time frame, but that's because you're averaging in these high multiples. As I shorten the time frame, you can see that the normal multiple for Cisco has fallen to 14.1. And if I draw it as a 10-year graph, you can see the normal PE ratio over this time frame has been about 12.3. So what this is doing is giving us a sense of valuation. On a normal PE basis since 2011, Cisco would be moderately overvalued here, but only a little bit. It's currently yielding 3.4%. It's a $169 billion market cap, AA rated. So Cisco looks very reasonably priced here with a PE of 14, even though it's moderately higher than its more recent normal PE ratios that the market's been applying over the last several years. Now, as you go down into forecasting here, there are 27 analysts who are forecasting Cisco to earn $2.44, which is a very moderate growth rate for fiscal year 2018, which ends in July of 2018. Last year, they had a flat year. Earnings only grew 1%. The average growth rate between now and going out to 2020 is only 5.1%. So you can run some what-if calculators here, and I think this is important. I want to talk about this just a little bit. The idea of these calculators, and they are calculators, is to tell you that if this stock traded at a normal valuation, I'm going to the normal PE here with these same earnings estimates, that there's not a lot of return that could be expected from this stock if it stays at that low PE. If the PE got back up into the 14-15% range, then Cisco could deliver double-digit returns. But the point is, this is a stock whose growth rate has slowed down dramatically. It's now become a dividend-paying stock since it started paying a dividend in 2011. It's reasonably valued, but it's not expected to grow very much. So when you're doing your due diligence on Cisco, all that needs to be taken into consideration. With my next example, I'm going to go directly into Goldman Sachs, and I'll move a little quicker for you now. The thing about Goldman Sachs, when you look at their long-term history, you see a lot of cyclicality, but you also see a price that has really tracked the company's historical operating results quite consistently. During rising periods of earnings, the company's price rose. During falling periods of earnings, the stock price fell, etc. Right now, the stock is trading at about a blended PE ratio of 13.1. If you shorten the time frame here, a 12 PE has been relatively normal since 2010. The stock is forecast to grow at a decent rate going forward of 11%. The long-term trendline growth is almost 12%. But the real key is, and going to the analyst scorecard, can you really trust that growth? In the case of Cisco, analysts have been missing earnings the last couple of years when they've been making a forecast 1 year in advance. And they've also had a couple of misses in recent years when they're making forecasts 2 years in advance. Bottom line is, analysts get this company right more than half the time, but I think you do have to consider the cyclicality. In other words, what I'm questioning here is how accurate these analyst estimates are going to be, because there's a possibility that we could have a cyclical downturn at any time. So that's our Goldman Sachs. Our next is probably the much aligned IBM, and there's some very interesting stories here in the IBM graph. When you look at IBM over the long run, you see a period of some really great growth up through 2013, and then we see 3 or 4 years here of dropping earnings, and then we see earnings beginning to stabilize. They had a pretty decent quarter, and that got a little uptick in the stock here just recently, and you can see we had a nice little pop in the stock. But you know, relative to the company's normal multiple over recent years, this stock would only be fairly valued here. Growth is not forecast to be very much over the next couple of years. Longer term, the company is forecast to grow at about 5%. But that, again, if you use these normal multiples of like 10 or 12 times earnings, this could be a decent return stock. I believe the primary allure for IBM right now is the dividend, yielding 3.8%, just under 4%. And it's been recently yielding more than that. I think when you look at this company from a standpoint of operating cash flow and free cash flow, you also get some additional insights here in that the dividend is well protected, and I think that's the primary reason for investing in the stock right now. Whether you're looking at operating cash flows or free cash flows, IBM is covering their dividend quite nicely with their cash flow generation. My next example is going to be Intel, another tech stock, and it's very similar to what we saw with Cisco. From an operating cash flow, the stock is trading at a pretty reasonable valuation. If you get rid of this anomalous period, you can see that this has been about a 15 times free cash flow normal multiple. It's a little high on that basis. However, if I go to adjusted operating earnings, I get a slightly different picture. The stock currently yields 2.7%, and it would be moderately undervalued based on its operating earnings, and it's even trading right in line with its historical normal PE ratio of about 13. So Intel is reasonably priced here, but as we've looked at these other stocks, going forward, there's not a lot of growth expected. So if we go to normal multiples of 12 or 13 times earnings, there's not a lot of return expected on Intel. This would be, again, another case of a dividend play. Valuation is reasonable, but growth is rather anemic. And then last but not least, I'm going to look at Verizon and run through Verizon's history. And when you look at Verizon, there's a lot of things that strike me about this stock. Number one is it's not really growing at all. We're calculating a 4% growth rate here, but if I shorten that, you know, I still have 4%. Forecasts are for very low growth going forward, actually less than 1% a year, 1/10 of 1% a year, and long term only 2.8. The primary allure, once again, for this stock is the 4.8% dividend yield. But I do want to bring everybody aware of the historical dividend record of this company. They went through the 2 recessions without cutting their dividend, but they did freeze their dividend during the 2001 recession. They held it at $1.54 for several years. In 2005, they kept it at $1.62. When we got into the Great Recession of 2008, they were able to raise their dividend, but they've been increasing their dividend by about 2 or 3% over the last 4 or 5 years. So we're not really looking at a lot of dividend growth here, averaging 2.8% since 2013, but it does offer a high yield. Now, the one stock I didn't cover is the Dow DuPont, as I mentioned earlier, and that's simply because there's no data available because the 2 companies merged, and so it's only been trading since September of this year, so we really don't have any data to judge that one by. But the bottom line is, of these 5 Dow stocks, they are all very attractively valued. However, I think, as I mentioned in the written part of this presentation, you have to really consider the future growth rate. There's not a lot of growth going forward in these companies, even though their valuations are reasonable. Some of the more overvalued Dow stocks might actually generate higher rates of return because they're growing so much faster. This has been Chuck Carnevale saying thanks for listening.